Have you ever wondered how closing a credit card could affect your credit score? This is a question that lingers in the minds of many, especially when considering financial decisions. The answer is not as straightforward as you might think. The act of closing a credit card can indeed have a significant impact on your credit score, and it's essential to understand this before making such a decision. A credit card is more than just a plastic card. It's a tool that shapes your creditworthiness, a factor lenders consider when you're applying for loans or even renting an apartment. Closing a credit card might seem like a step towards financial freedom, but it could also be a step back if it leads to a dip in your credit score. So before you decide to cut up that card, let's delve into the world of credit scores and understand how credit card closures can affect them. Stay tuned as we delve deeper into the intricacies of credit scores and credit card closures. Before we proceed, it's crucial to understand what a credit score is. Picture it as a report card for your financial behavior. It's a number that lenders use to evaluate your creditworthiness, or in simpler terms, your reliability in paying back debts. So how is it calculated? Credit scores are computed using algorithms that consider several factors from your credit report. These factors include payment history, credit utilization, length of credit history, new credit, and credit mix. Let's delve a little deeper into these factors. Your payment history is the most significant piece of this puzzle, accounting for about 35% of your score. It reflects whether you've paid past credit accounts on time. Late or missed payments can take a serious toll on your score. The second significant factor is credit utilization, which makes up nearly 30% of your credit score. This is the ratio of your outstanding credit card balances to your credit card limits. Lower utilization rates are better, as they indicate you're not heavily reliant on credit. Next, we have the length of your credit history, which contributes about 15% to your score. This includes the age of your oldest credit account, the age of your newest one, and an average age of all your accounts. New credit, which represents around 10% of your credit score, takes into account how many new accounts you've opened or applied for recently. Too many can indicate risk and potentially lower your score. Lastly, your credit mix, or the different types of credit you have, accounts for the remaining 10%. Having a variety of credit types, such as credit cards, retail accounts, installment loans, mortgage loans, and others, can positively affect your score. So why is this score so important? Well, it can influence the outcome of many of your financial activities, from getting a loan or credit card to renting a house or even landing a job. Now that we understand what a credit score is, let's explore how closing a credit card can impact it. Two key factors that determine your credit score are your credit utilization ratio and your credit history. Let's start with the credit utilization ratio. This is simply the percentage of your total available credit that you're currently using. Let's say you have 3 credit cards, each with a limit of $5,000. That's a total of $15,000 in available credit. If you've charged $2,000 across all cards, your credit utilization ratio is about 13%. Credit scoring models generally favor a lower ratio, as it suggests you're not overly reliant on credit. Now let's say you decide to close one of those cards, and you still have that $2,000 balance. Your available credit drops to $10,000, and suddenly, your credit utilization ratio jumps to 20%. Even though you didn't charge any more money, your ratio increased, which could potentially hurt your credit score. Now let's talk about credit history. This refers to the length of time your credit accounts have been open, including the age of your oldest account, the age of your newest account, and an average age of all your accounts. Longer credit history typically translates to a higher credit score because it provides more information about your long-term financial behavior. When you close a credit card, especially an older one, you might shorten your credit history. This could also negatively impact your credit score. For example, if your oldest credit card is 10 years old and the rest are just 3 years old, closing that 10-year-old card could significantly reduce the average age of your accounts, which could lead to a lower credit score. So, to sum it up, closing a credit card account can increase your credit utilization ratio and shorten your credit history, both of which could negatively impact your credit score. So, closing a credit card may not always be a good idea, but there are exceptions. There are times when closing a credit card can actually make sense. While it may seem counterintuitive, given all we've discussed about credit utilization ratios and credit history, there are indeed certain scenarios where it might be in your best interest to bid farewell to a credit card. Let's dive into a few of these scenarios. The first one is when the credit card in question carries a high annual fee. If you're not taking advantage of the benefits or rewards that come with the card, this annual fee can become a financial drain. It's like paying rent for a room you never use. So if the costs outweigh the benefits, it might be time to close the card. The second scenario is when a card encourages overspending. Credit cards can be a double-edged sword. While they can help build credit and provide rewards, they can also lead to a spiral of debt if not used responsibly. If having a certain card in your wallet tempts you to spend beyond your means, closing it could be a wise move. Another circumstance where closing a credit card might make sense is if it's linked to a specific retailer or brand that you no longer patronize. Store cards can come with high interest rates and limited usability. If you're carrying around a card for a store you no longer visit, it could be time to close that account. Lastly, if you're juggling too many cards and struggling to manage them all, simplifying your financial life by closing a few might be the best course of action. Having too many cards can make it difficult to keep track of payment dates, which could lead to missed payments. And we all know that's not good for your credit score. Remember, closing a credit card should never be an impulsive decision. It requires careful consideration of factors like your credit utilization ratio, credit history, and the potential impact on your credit score. So, what should you do if you're considering closing a credit card? Let's delve into that in the next scene. Stay tuned. Before you decide to close your credit card, consider these tips. Firstly, ensure you pay off any remaining balance on your card. This is crucial because closing a card with an outstanding balance can have a negative impact on your credit score. Even if your card has zero balance, some card issuers might still charge residual interest. This is the interest that accrues between the time you receive your statement and when you pay it off. So, double-check your balance before making any moves. Secondly, consider the impact on your credit utilization ratio. This ratio is the amount of credit you've used compared to the amount of credit you have available. Closing a card reduces your available credit, which can increase your credit utilization ratio and potentially lower your credit score. Therefore, it's wise to consider how closing a card might affect your overall credit picture. Thirdly, consider the age of your credit card. The length of your credit history plays a significant role in your credit score. If the card you're considering closing is one of your older cards, it may be beneficial to keep it open to maintain a longer credit history. Finally, instead of closing your card, you might want to consider downgrading it. If your card has a high annual fee that's not justified by the benefits you're receiving, ask your card issuer if you can switch to a card with a lower fee or no fee at all. This way, you can keep the same account open, thus preserving your credit history and utilization ratio while avoiding the high fee. It's important to remember that every financial situation is unique. There's no one-size-fits-all answer when it comes to managing credit cards. That's why it's essential to understand the potential impacts and alternatives before making a decision to close a credit card. Now that you're equipped with this knowledge, you can make an informed decision. Let's do a quick recap of what we've covered. We began by defining a credit score. This 3-digit number is a measure of a person's creditworthiness, essentially a numerical snapshot of your financial trustworthiness. Lenders, landlords, and even employers may use this number to gauge your reliability. Next, we delved into the impact of closing a credit card on your credit score. When you close a credit card, it affects two key components of your credit score: your credit utilization ratio and the length of your credit history. The credit utilization ratio is the amount of credit you're using compared to the amount of credit available to you. Closing a credit card reduces your available credit, which can increase your credit utilization ratio, potentially lowering your credit score. As for the length of your credit history, closing a card, especially an older one, can shorten your credit history's average age. This too can negatively impact your score. However, it's not all doom and gloom. We also explored scenarios where closing a credit card makes sense. If a card has high annual fees that aren't justified by the benefits, or if it tempts you into overspending, closing it could be a financially savvy decision. Finally, we shared some tips to consider before closing a credit card. If you decide to close a card, ensure to pay off any outstanding balance first. Also, consider lowering your credit utilization ratio on your other cards before closing one. And remember, it's generally better to keep older cards open as they contribute to a longer credit history. So there you have it. While closing a credit card can have potential downsides, it's not always a negative move. It's all about understanding the implications and making an informed decision based on your individual financial situation. Remember, the decision to close a credit card should be considered carefully. as it can have a significant impact on your financial health. Thanks for watching.